wonderful to see hundreds and hundreds of people coming through, some questions popping through, and this new age technology obviously gives us a nice perspective to be able to communicate with people en masse. Question for you, Nolan. Why is the FRA market so bearish, and how would you position yourself to profit if rate hikes don't materialize as quickly as is priced in?
Thanks, Pete. I think two questions there. Why is the market so bearish? I think as the market sort of over time has these sort of waves of optimism and pessimism, sentiment waves, if you want, that come and go. And I think sentiment has been negative. I think it's been negative for a lot of the reasons we touched on, concerns around China, concerns around inflation, all the rest of it. And that creates a negative sentiment. That pushes the market, and the pendulum, the sentiment has just pushed the market too far. But that's a great opportunity, as you say. In terms of how do you position to take advantage, it depends probably on who you are. If you're a hedge fund manager, to be honest, you buy a lot of FRAs, lever it 20, 30 times, and you kind of wait and hope that things work out quite quickly, because it's a very, very strong position. If you're a fixed income manager like I am, what you do is you buy a collection of specific bonds. You buy 186s, and in fact, any bond maturing out to about 2032 will benefit from this. If you're actually a retail investor, it's a bit more difficult, and what you need to do is buy either the Anchor BCI bond fund, which gives you quite a strong exposure to it, or you buy the Anchor flexible income fund, which is a watered down exposure effectively to the same phenomena. So that's how you take advantage of it. But the long and the short of it is, what we're saying is, if there are going to be fewer interest rates hikes, buy bonds.
Yeah, thanks, Nolan. I mean, obviously, it goes without saying that in all of the funds that we manage and you can invest in, or invest your clients' money in, it represents the kind of views that we're talking about. So all of that's taken into account, and we're giving you the expectations of where they can go. Pete, you run our managed fund, responsible for the Global Stable Fund, so kind of diversified portfolios across asset classes. Maybe to basket two question themes that are coming through. The question in the market of growth versus value versus quality, where you see those different. We typically we tend to invest with a growth mindset, and that's the focus. We believe that growing business is where money is made. Perhaps a comment on that. How we've done. Possibly last year was a little bit better for growth than this year, although David showed that the big tech companies are doing quite well. So just maybe a general comment on that. And then no investments forum would be the same without some questions on Bitcoin. So maybe a comment on that, and a particular reference to the recently listed Bitcoin ETF.
Okay, excellent. Thanks, Pete. I was wondering who would get that Bitcoin hospital pass, but let me start off with the value versus growth thing first. So Gebo touched on this a little bit recently, and Pete, you've mentioned that our bias is towards structural long-term growth, which is much easier to identify and has a much bigger compounding impact because it lasts for so much longer. The value stuff is more reliant on that sort of rising tide of economic growth lifting all boats. And so sort of lower quality companies that will just get a temporary boost from this above average economic growth tend to fall into the value camp. We find it harder to time that stuff, so we tend to avoid it. But having said that, our thesis is that economic activity will be at above average for the next year or so as we see this full economic normalization and mobility normalizing play out. So we do think there will be somewhat of a rising tide for some of these cyclical areas. But as is always the case with these things, it's very important to have self-discipline to know when that rising tide has run its course. That's a much harder skill to perfect. And so we think that there's potentially some rising tide for value at the moment, but very hard to know when to sell that stuff. So that's from the value growth perspective. From the Bitcoin perspective, it's an interesting one. I managed to talk my mum out of buying Bitcoin about 300% ago. And basically the argument that I'll give here, and it was the same one that I said to her, is I don't, as fundamental investors, very difficult for us to understand what the value of Bitcoin should be, because for companies and bonds and other income generating assets, it's easy for us to estimate what we think these things are going to deliver in income in the future, and then kind of bring that back to an anchor valuation of what we would pay for those cash flows now. So Bitcoin, much like gold, doesn't generate income for anyone. And so then you're left with a purely supply and demand argument. Will there be more buyers of Bitcoin than sellers of Bitcoin? And for both Bitcoin and gold, we can roughly calculate the supply. So we know that for both gold and Bitcoin, about 80% of the supply is already kind of out there in the market, and there's about 20% that will come on over the course of the next few years. So we have an idea of the incremental supply of these things, but the big unknown is the incremental demand. And here I think it's going to be extraordinarily volatile. So you talked about the ETF that's just been launched. We've obviously seeing the technology in terms of the financial markets evolving pretty rapidly here. And we've seen futures market created for Bitcoin and Ethereum over the course of the last few months. That's now converted into ETFs. So you can buy an ETF in the US, which is based on the futures price on the CME in the US of Bitcoin futures. And so the opportunity for retail investors to get exposure to the Bitcoin price is increasing. So that's kind of a structural driver of demand, which should push the price up. What's very difficult for us to quantify is the trajectory of that demand increase, and what's probably even more important and more critical to the Bitcoin equation is the regulatory environment. We know that central banks and the like are looking at this thing at a very detailed level, and pen strokes can change the value of these things pretty quickly, as we've seen recently in China when they just suddenly decide that nobody's allowed to trade in Bitcoin. And so that volatility of demand pull is very hard for us to forecast. And on that basis, it's hard for us to come up with an anchor value for these things based on cash flows and some sort of stable trajectory of demand. It's just something that's probably beyond our scope of expertise. Hope that helps.
Thanks, Pete. Dave, maybe over to you to basket two questions. One, a question on Alphabet's investment in SpaceX. I'm not actually sure whether they are. Perhaps you know more. And then a question about, global markets. Are there portions of the market which have been left out, or the valuations still look reasonable? I know in your Worldwide Flex Fund, which is more conservatively positioned, you've got exposure to stuff like pharma and banks, and maybe talk through that. And there's a question just lastly around your asset allocation in the Worldwide Flex Fund and how you approach that.
Good. So, Alphabet has invested, I think, a small amount in SpaceX. I think there was a capital raising several months ago. And that business is now, I think it's probably valued at up to 100 billion now, SpaceX. That investment by Alphabet, it might have been to get cloud services to, become closely associated. So I'm not sure who the cloud provider is for SpaceX. But the prospects for SpaceX are absolutely phenomenal right now. There was a long piece in the FT, I think last week, just talking about how SpaceX potentially could monopolize some of the major launches into space. Obviously they've got that Falcon 9 rocket at the moment, which is being used by a lot of satellite companies, and it's become an incredibly efficient engine to get things up into space at a relatively low cost. And they're going to be launching their enormous rocket. I can't remember what that rocket is called, but that will be for much wider exploration into space. And at this stage, there's no competing rocket for their major, for the big rocket that's due to come out. So I think it's a great investment to have made, and I guess for now it might be so that they would be, potentially offer cloud services for SpaceX. So just moving on to some of the value areas in other parts of the market and maybe asset allocation. Look, I think the banking sector it has done well this year, right? So it's done much better than the broader market. A company like Bank of America is up about 50% this year. That's more than JP Morgan. And they've moved up as the yield curve has moved up. So it's part of the reflation trade. But they generally do benefit with a pickup in the 10-year yield. So I still think there's some value in the banks. They're not as cheap as they were. And I think once loan growth starts to pick up, because loan growth, everyone's looking for loan growth right now, and that should pick up next year. So I think the outlook for the bank shares is fine. Credit conditions are the best we've had almost in 50 years. So in other areas, there are some defensive other areas. I mean, the pharmaceutical sector is trading at the biggest discount in well over a decade. And those shares generally do very well if you have an economic slowdown or if you have a major correction in the market. And then there'd be things like telecom services, which no one really wants to own right now. So in a market where you've got some very expensive shares and some very cheap shares, when you buy some of those cheap shares now, there are not many buyers alongside you. So there are some very cheap sectors, and I would put telecom services and pharma in that category. If you look at asset allocation right now, look, it's interesting. I mean, I saw a chart from John Authers yesterday. He's the great Bloomberg, and he used to write for the FT. And basically, I mean, he was saying that allocation to equities is the highest it's been in several decades now. People have given up on bonds. Don't really want to own cash. So, obviously there is no alternative. So the TINA argument is strong, but now people are saying resistance is futile. So stick to equities and don't resist. So that's the common feeling out there. I don't necessarily, I don't like that. So I have kept my asset allocation quite low. To equities, or relatively low for to what I'm used to. So equity exposure for the Worldwide Flex Fund is it's just under 66%. And the rest, frankly, is in a selection of different currencies. So it's quite short-term money. So I'm taking this as a place to preservation of capital, and that there's optionality in that cash.
Thanks, Dave. Maybe to round off with one last question to Nolan, there's a question, and I know there's been some. The reason I'm focusing on this and choosing the question is there's been some news in the last week or two. The question around SA foreigners getting out of SA bonds and into equities, and in fact, it hasn't been what we thought it was. So perhaps you want to add to that, Nolan?
Yeah, so that's actually an interesting one. So every day the JSE publishes the amount of bonds that foreigners have bought or sold, and then you sort of get a running total, which means that, you get to June, you get a sort of running total, whatever. Foreigners have sold 60 billion of SA bonds. So anyway, this continues. And about a month ago, the chairman of the JSE, was actually CEO of the JSE, I think, stands up and just gives a general speech or presentation and says, well, foreigners have bought 20 billion rand of bonds. And everyone sort of falls off their chair and says, but the JSE is publishing numbers that say foreigners have sold 80 billion rand of bonds. You're standing out telling us 20 have been bought. What's going on? So, there's a bit of hoo-ha at the time, disappears off. And about 2 days ago, the JSE pretty much comes out and says, look, we've found a better way of counting how many bonds foreigners are buying or selling. And we know we told you that they'd sold 100 billion rand of bonds. We were wrong. Actually, they did buy 21 billion rand of bonds. So the JSE's kind of come out in a bit of a mea culpa, if you want, and said, actually, foreigners have been buying our bonds. We just weren't counting them correctly. And I mean, lots of technical reasons as to why it wasn't counted correctly, which I'm not going to go into here. But the long and the short of it is suddenly 2 days ago, the bond market's sitting there going, wait a minute, foreigners bought 20 billion of our bonds. The sentiment isn't as bad as we felt. And actually, SA bonds rallied because, you know, when you look at it in that perspective, it actually feels a heck of a lot better. So, you know, so the latest numbers from the JSE are that foreigners have been buying our bonds gradually. It's not exactly a runaway purchases over the last while. And that's probably good. I think it's very few foreigners that directly switch from emerging market fixed income to emerging market equity. You know, you'll probably find that the emerging market income guys will you know, sell their bonds from time to time. They definitely do that. And, you know, equity guys take a very different exposure and have different investment drivers. So I don't think it's a pure rotation that explains what's going on. But certainly, you know, it's not as dire for bonds as people were led to believe.
Great, thanks, Nolan. Okay, guys, we've gone over the allocated time. Sorry, there's heaps of questions we weren't able to get to. Please, you know, feel free to engage with us directly if it's stuff that's important to you. We will be distributing the slides from this. Thank you very much. Hundreds of people from all over the country have come in. Great to have you around, and we look forward to chatting to you again soon.